Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York. It is Tuesday, 23rd day of May 2017, and this is the Daily Report for Gold and Silver. We are seeing that 1-2 punch with a stronger U.S. dollar and profit taking, dragging down the precious metals complex as a whole. That is everything except palladium on the day. Gold is currently trading lower by about 0.8%. Current print 12.51, putting it down about $10.40 on the day. Low on the day has been 12.50.50, and the high on the day has been 12.63.80. We are certainly much closer to the low than the high, and as I said, we are trading under pressure. Silver also trading lower today, off about 0.7%. Our current print on silver, we'll go ahead and bring that up, is 17.06. Putting it down almost 13 cents on the day. The low on the day is 17.03 and the high 17.30 and a half. Over to platinum. Platinum trading off $5 or 0.5% at 9.45. And as I said, the only precious metal in the complex to be trading positive today is palladium, trading up 1.8% at $772.85. So traders, absolutely no doubt, substantial pressure placed on the precious metals markets today, specifically gold and silver, with both trading under pressure, gold trading off by 0.8%, lower by over $10 at 12.50.80. That is our current print. The question that we need to ask ourselves and what we need to ascertain is, on a technical basis, has today's move created any major chart damage? And to that end, I want to take a look at a couple of technical studies, specifically our moving averages, 200-day and 50-day moving average, and that is exactly what we have on this chart, standard candlestick format, each candlestick representing a day. This long dashed red line representing the long-term 200-day moving average, and the shorter term dashed blue line representing a 50-day moving average. Now, we just made note the other day of the fact that we had this golden cross. We actually had the shorter term 50-day moving average move above the longer term 200-day moving average, and that will typically signal a major key reversal in the market. Now, that is if you have a sustained move. And what I mean by that is if we look at the last time this market traded above these moving averages, well, the first thing that we have to note, of course, is they did not cross right here. But this is really a false breakout. When you see something like this breaking above both the 50 and 200-day moving average, but then quickly coming back in alignment, in other words, the market bounced up, hit these highs. This is the highest high gold has traded to this year. But as quickly as it came up, market came and tracked back down, breaking below both these averages, 200-day as well as the 50-day. But the one thing that you want to realize is when this occurrence took place, you had the shorter term below the longer term, which meant that we were still either coming out of a bearish mode or in a bearish mode. So when we look at current activity and take what I just said into perspective, one, we are above the 200-day moving average. The 200-day moving average is at this point below the 50-day moving average, and the price point that we are currently trading at is right at the 50-day moving average. My sense is that as long as gold prices maintain a price point above $12.49, then in fact we could be looking at a simple bout of profit taking as opposed to a failed upside attempt. Now, I did get a question today because on Friday I talked about the fact that we would probably look to add to our long gold positions next week. And the question was whether or not that is still something we're looking to implement. And I have to say, with recent price activity, specifically today, it definitely puts adding a position on hold. Now, if you recall from yesterday's show, we did in fact recommend that we phase out of the Junes into the August contracts. Most subscribers should have done that. In hindsight, might have been a better move just to pull profits. And if I knew the future, I would have told you that. However, I'm going by straight technical knowledge. Our stops are below 1245, so I believe that we still have a safety factor. However, before I would recommend adding to the position that we currently have, I would need to see two things happen. The first occurrence would be that we got this market bouncing in some way off of this price point and start to see higher pricing and some solid support in the area of approximately $1,250 per ounce. So traders, as far as silver goes, silver has been trading to a different drummer, so to speak. Take a look at the chart that I've just pulled up, 50-day and 200-day moving averages. And unlike gold, in which we had that golden cross, we are still trading below, in terms of silver pricing, below the 50 and below the 200-day moving average. We had more downside pressure as this market came down. And one of the reasons for adding silver to this current trade was I felt it was extremely oversold. Now, we have this market come down, and my sense is as long as we are trading above $17 per ounce, and that's really going to be our line in the sand with 1703 as our low today, as long as we're trading above 17, I can honestly look at this as a round of profit taking as opposed to a key reversal or a false upside breakout. Now, unlike gold, it wouldn't be a false upside breakout because we never broke above the 50 or 200-day moving average. Therefore, my recommendation is to maintain your current long in silver as well as your stop. You should have effectively sold out of your June and bought into August gold. If you've not, you might want to just consider taking profits in the June and holding off until you go and buy the August to see if there's any more downside pressure. In other markets that we follow, strong dollar today, that of course contributing to weakness in the precious metals. As we look at the dollar index on a nice upside bounce, trading up about 0.4% at 97.30. Now, the key with the dollar as we look at the precious metals is, for example, gold was down about 0.8%. So you can see it's an equal contribution between a stronger U.S. dollar and selling in the market or profit taking. Equities showing a pretty strong round. U.S. equities trading higher on the day, a gain of 43 points in the Dow Jones, trading at 20,937. When we look at the Standard & Poor's, that at 2398.42, although it has flirted with 2,400 on two occasions intraday, but was unable to breach that glass ceiling, so to speak, with the intraday high at 2400.85. And lastly, the NASDAQ Composite Index, in essence unchanged at 6138. So traders, as far as today's downside pressure in precious metals, we can account for about half of it with the strong U.S. dollar. So therefore, the real question we need to ask ourselves is whether or not today's activity in the dollar can be construed as a turning point or whether it's simply a round of profit taking on the short side as we saw profit taking in gold. To that end, I've pulled up our daily chart so we can ascertain a logical answer to that question. And the first thing that kind of sticks out is our fib retracement, which really goes back from July of last year up to these most recent highs just below 104. When we do that, 96.5 roughly is our 61.8% retracement. We've not seen the dollar index move to these lows, although very, very close to these lows. We're trading at 97.28. Therefore, my sense is that we could, in fact, see this market break lower and find support in this area and bounce, but this isn't that logical of a place to look for a bounce. I do believe that over time, we will see a continuation of lower U.S. dollar pricing, first of all. Second of all, I believe that the key to that is if and when the market breaks below a 61.8% retracement, which comes in roughly at 96.5. So If the market bounces back up here, I think it's going to be kind of a dead cat bounce, a short-term bounce before tracking to lower pricing. I'd want to really see on the dollar index a clear break below the 61.8% retracement. And at that point, my sense is that we're probably headed to about 94 on the dollar index. So traders, the real question that we need to ask ourselves today is whether or not today's action created any real major chart damage. And as I said during the technical study portion of the show, we did close at the 50-day moving average, but we are still a few dollars above the 200-day moving average. As long as gold prices are able to maintain a price point above the 200-day moving average, we can continue to look at this as a round of profit taking rather than a key reversal that had no steam. In other words, when it broke above the 200-day moving average, when we had the golden cross, that particular move up didn't have the follow through if in fact we break back below that. However, if we are able to maintain a price point above the 200-day moving average, we can look at this recent price action as merely a round of profit taking rather than a failed upside market move. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.